That's how I encourage people to think about it whenever they're determining, hey, does it make sense to go cash out, to go get a cash out refinance on this property? The question is, what are you going to do with that money? Because you're paying on it day one. What's going on, everyone? Welcome to another episode of Remote Investor. I'm Michael Album, and today I'm joined live by my co-host,
Tom Schneider.
And today we're going to be tackling an issue that I think a lot of investors are struggling with, are questioning, and are just trying to figure out what to do about. And that's whether to get a HELOC or to leverage a cash out refinance. So let's get into it. All right, guys, let's just dive straight into this one. No dancing around here. Tom, just for all of our audience members that might not be familiar, what's a HELOC? Can you give us a rundown, what they are, how they work, how to think about them?
Yes, a HELOC is an acronym for a home equity line of credit. And what that works out to be is basically like a credit card that's secured by your house with generally a pretty high balance. And the way that balance or available credit is calculated is depending on the company that's offering the HELOC, it takes an appraised value of your home minus the existing loan that's in place, and then up to a certain percentage value of the home to come up with how much is available. And oftentimes, homes that have appreciated a ton, there's just like a cap for some HELOC companies, where it goes up to like $200,000. So like really meaningful amount. And since that line of credit is secured by your home, it's often really favorable rates, but still it's, related off of par or whatever the federal rate is. So I have a HELOC, it's roughly 7.5% right now. And if I was to look around at other types of loans, we're looking at like north of 8 or 9%. And the reason it's able to be so great is because it is secured by your home. So good overview, Mike.
No, I think that's a great overview, Tom. And I'm curious from your experience, since you've got a HELOC on a property, are they easier to get on investment properties or owner occupant, or does it not matter?
Yeah, that's a good question. I have a HELOC on my owner occupied properties, and I wouldn't be surprised if a lot of banks are kind of limit to that. And actually, the company that we did it through for our owner occupied, it didn't. The lender don't really like me because I have like a whole bunch of like loans in my name. So it's actually through my wife's. So it's on the house that we both own, but the actual HELOC itself is through her. I haven't gone out and like attempted to get a HELOC on the others just because like the line of credit is large enough on our current home. Like I wouldn't want to like endure, additional. I mean, it's not necessary. I suppose it's something I could go investigate. But I think oftentimes for that type of a product, like a lot of lenders, I think would prefer an owner occupied home.
I've heard the same. I had a line of credit on a property that I owned that was free and clear. I owned it. There was no debt on it, so they were fine to put a line of credit on it. But I've also heard the same, that it's tougher to do on investment property for whatever reason. And I'm curious, Tom, from your experience, what was the process like to get a HELOC? Because if anybody listening has ever gotten a mortgage, you're probably like me and thinking it's a ton of brain damage. I don't want to do that. So if I'm considering between cash out refinance, which is basically just another mortgage, versus HELOC, what's the process and approval like?
It is meaningfully easier and less overhead. I mean, there still is, it's probably dependent on the lender, but oftentimes they'll do some sort of desktop appraisal. They might send someone out to do an appraisal, but it's meaningfully less expensive and less overhead. So thinking of the particular steps off the top of my head, I think there's like an initial kind of pre-qualification online, and then I think if they, and then there's a period at which they're like appraising the home, kind of confirming, coming up to a value, which is going to inform how much the HELOC can go for. And then there's a closing. Okay. I don't remember if there was an actual signatory. What do they call them? People who come out and like watch you sign a piece of paper.
Oh, a notary?
A notary. I mean, there's definitely notaries when you're like getting a mortgage. I don't remember if there was a notary with the HELOC, but the net of it is the HELOC process was, like far less intense than like a standard. Because there's also no like contingencies or inspections or whatever. They're just going to come up with the value and then, sign on the line.
Love it. Love it. And while they're easier to get and super useful, I just think it's important to take this moment and really drive home the point that it is a second mortgage on the home, right?
That's right. Yeah. Yeah. I can't, you could probably speak better to the mechanics, on like, doomsday default, all of that kind of stuff. But it is a second mortgage on the home. So it's like secured by the home, which is why the bank is a little bit more comfortable having like a really high limit at a pretty low rate. So, I mean, it's a really great flexible tool to have in your pocket.
Yep. No, I think that totally nails it. And I'm curious, Tom, from your perspective and from your experience, the payments that you're making on a HELOC, like walk us through what the actual mechanics are of using a HELOC. Okay, so let's say I've got a $100,000 HELOC on my house now. What do I do with it? Do I get $100,000 wired to me at closing? Like how does this work?
It is a use as you need. So after you close on a HELOC, you'll typically get like, it'll open an account with whatever that lender is. And I have a checkbook for that particular HELOC where you almost write checks like it's just like a bank account. And then, as I'm, writing a check or, depositing money, and I can write a check to myself. I could like take the full, whatever, 200,000, write a check to myself, and then, whoo, I got $200,000 in the bank. But so it's really easy. It feels very analogous to just having a checking account, except it's debt. It's a line of credit with like a very distinct kind of end to it. And kind of continuing on the mechanics of like having it, there are some important things to ask about in getting a HELOC. With my HELOC, they put a cap on actually the monthly payment that you can make back towards it. So I wasn't aware of that until I had it, and I tried to make a payment beyond, a certain dollar amount, and it's like, oh, you can only pay back, which kind of seems a little bit predatory. Like, doesn't feel totally right in my stomach if you're like to have the money to
Yeah.
pay back. Yeah, but
Forcing
I've
you
used
to extend the payments.
totally. I mean, I HELOCs are great, but there are some weird kind of like intricacies of it of a HELOC where depending on your payment period, how much you can pay back, which I wish I had known earlier. Happy to share those that as a finding, with you
Yeah.
here.
That's really interesting. Okay, so
Yeah.
so aside from the minimum or rather maximum payment you can make, is there a minimum payment? Like what does that look like? Is it how is that payment calculated?
Yes. So, there's a, percentage of interest that is not fixed. It is a variable rate. And when I initially took my HELOC out, it was very low and it has moved up pretty significantly. It's still cheaper than any other type of debt out there, but it is bound to whatever the interest rate is. And when I'm looking at my account, it kind of feels just like a credit card when you're looking at it. Every month there is an interest charge that is calculated based off of the balance that you have off, and then you pay above and beyond. So there's an interest payment that you make every month, and then there's paying down the balance, the remaining principal, I think is what you would call it. And that's it. Every month there's a minimum. If I don't have any money taken out on it, I don't have that interest because there's no interest against it. But that's the way that it works on monthly payments. There's the baseline interest, and then there's above and beyond that, kind of working it down.
Okay. I dig it. And I'm just curious, like for yours particular situation, I've actually never heard of this. Someone having a maximum limit on how much they can pay back. Is it a set dollar amount or is it a percent of your outstanding balance?
I believe it's a set dollar amount. And when I am in their like portal, like putting it in, it's like, oh, this is above the monthly contribution or whatever. And I don't know. Like I said, like it doesn't feel totally great. I'm happy to have it and it has like been helpful. But if you do take like a chunk out to do something, it's something to think about that if they're delaying you in paying it off, there's that many more months of incurring interest, which kind of
Right.
stink, Yeah.
Yeah. Yeah. Yeah. Yeah. No, I think that makes total sense. And that is a bummer.
Yeah.
Something that you'll probably never get caught with again, would be my guess.
Yeah. No, I mean, it would have to be like pretty situational. But it's, good to know that and understand it.
All right, great, man. Well, thanks for the rundown on that.
Let's hear the explain like I'm five. What is a cash out refi?
Well, little boy, come here and sit on the floor and I will show you via my storybook. So,
That's not creepy at all. Not creepy at all. Go ahead. Yeah.
damn it. So, cash out refinance is is similar to a HELOC in that the bank is going to look at the value of the property, and then they're going to say, you can take a loan up to, call it 75% of the property's value. They call it loan to value. So if you have a $100,000 property and they will allow you to go up to 75% loan to value, you could go get a loan for $75,000. And if you had an existing loan on that property, let's call it $50,000, the lender would give you a new loan of 75, pay off the existing loan of 50, and then you're left with the difference, which in this instance is 25,000. So you're going to get that money, that $25,000 is going to be tax-free because in the form of a loan proceeds. And then you're just going to start making new payments. Your monthly payment was principal and interest based on the loan product that you got based on this new loan balance of $75,000. So cash out refinances, you can also do them if you don't have an existing mortgage on the property. So let's say you own this $100,000 property free and clear. There's no mortgage on it. You've either paid it off or you bought the property in cash to begin with. You would go do a cash out refinance where you're getting cash from the lender, $75,000, and they're just giving you that check since there is no mortgage to pay off. And so now you're going to walk away with $75,000 in tax-free cash to go do whatever you'd like with. And then that's your new loan balance is $75,000. You're going to make payments based on that. So in both instances, you're walking away with cash, hence the term cash out, and then you're refinancing the property. So you're putting new debt on it. So that's where that term comes from. And so depending on whether or not you have an existing mortgage, it's just going to dictate how much cash you're walking away with and if the lender is paying off an existing loan versus just giving you 100% of the proceeds.
I like it, Michael. How would you think about like opportunistic or unopportunistic kind of situations or scenarios to leverage a cash out refi?
Yeah, it's a really good question. And especially right now, given the high interest rate environments in 2024, it's really important to be thinking about. So when it comes to existing debt, so let's use this $100,000 property example. Let's say you have an existing mortgage of $50,000, that's the balance on it. But you bought this $100,000 property in the middle of COVID. And so you have a 3.5% interest rate on that $50,000 remaining. If you go get a new loan at $75,000, let's say your interest rate for the sake of discussion, 7.5%. And so you would have to determine for yourself, okay, are you willing to give up a 3.5% interest to take on a 7.5% interest rate to walk away with 25 grand in cash, right? That's kind of the calculus that you want to be thinking about. Now, as the property gets bigger or more expensive, those numbers, of course, can balloon pretty quickly. And so this $100,000 example is a smaller property, but what I think more people are finding is maybe they've got a $200,000 mortgage at 3%, and there's maybe $150,000 in equity or in potential cash out proceeds to then they could have access to, but at a higher interest rate. And so the calculation that then I run through is, okay, if I'm getting $150,000 in proceeds, what can I go do with that money? What kind of return could I earn with that money? And is that enough to cover above and beyond what the new payment is going to be between the original payment and the new payment, if that makes sense? So if my old payment on that money was $100 a month and the new payment's $300 a month, can I generate more than $200 a month with these cash proceeds to then cover the debt service that I'm going to be taking on because of the higher interest rate or because of the higher loan balance? So I know there was a lot of kind of moving parts to that, but that's how I encourage people to think about it whenever they're determining, hey, does it make sense to go cash out, to go get a cash out refinance on this property? The question is, what are you going to do with that money? Because you're paying on it day one, unlike a HELOC. Like you mentioned, if you don't pull any money out of the HELOC, you don't have a monthly payment versus regardless of what you do with the money for the cash out refi, you're making payments on that monthly.
I guess a little bit of like a crystal ball type question, or I guess personal. Like if I feel like a lot of investors having seen interest rates that were around, in the early 2020s, do you think it's going to be really tricky for you to do a cash out refi like in the like immediate, like without things getting close? I know it's a kind of a squiggly question, but would love to hear your on it.
Yeah. So like in 2022, early part of 23, when the Fed was announcing that interest rates were going to be going up, I spent like 6 months trying to button up all my financing and get as long-term debt as possible. So like as an example, I have a mortgage with a bank that I have a relationship with. It's a 10-year fix. It's a commercial property. So 5 unit plus small apartment building. It's 10 years. It's fixed for 10 years to 25-year amortization. The interest rate is 3.25%. I could have gotten that down to 3% if I had taken a shorter term, say 5 years. But I'm of the mindset that I didn't want to gamble with the fact that in 5 years' time, rates could be higher than they were at that point in time. So I was like, no, I want as much runway as possible, and I'm happy to pay for that. And so in thinking about the future, I'm someone that likes long-term debt. I don't like to gamble. And so when it comes to thinking about future cash out refinances, there's tons of equities. There's tons of equity in these properties that I don't plan on touching because I just don't want to go change out that 3.5% interest for 7.5% because then I am forced to go invest that into something and put those dollars to work. Somebody listening could think, well, that's unused equity. It's not doing anything for you. It's kind of a waste. You could put it to work. And while, yes, technically I could, where I'm at in my investing career at this stage in my life, I'm super happy with the performance of this property in terms of cash on cash return and the cash flow it's throwing off. From a return on equity standpoint, it isn't maxed, but I'm okay with that. I'm not in a position where I'm needing to grow. And so I'm super thankful that past Michael was thinking about these things and interest rate inflation and interest rate risk a couple of years ago, because now I'm in a really great position as opposed to people that took on floating rate debt or 3-year debt or 5-year debt. That debt's now coming due, and they bought the building at a 3.5% interest rate and underwrote it at a certain performance. And now their interest rate is doubling or sometimes maybe even tripling, depending on what type of property they have. That can be a big problem. That can be a big
Yeah.
problem versus the HELOC. If you want to tap into the equity, you just go get a HELOC on the property, and then you can be as opportunistic as you want. You find something that you like, you go buy it with cash, turn around, cash out, refinance it, pay off the HELOC, get rid of the variability, and then just put fixed debt on the thing for however long you can. And then you cash out, refinance again, or do a rate and term refinance when interest rates get better down the road.
Somebody once like teased me, and I was asking them a question, and it's like a question that I wanted to answer. So I'm going to ask a question for you to answer, but then I'm probably going to answer it as well.
I'm going to answer it better.
No. A very personal question. So like, having these, really awesome tools in place, with real estate financing, and having gone through a really interested point in time, do you think strategically, like there's some things you would have done differently, or do you think you kind of like stuck the landing over the last, 5 years or so? I'd love to hear your kind of opine on just kind of your, if you could, go back in time, like what, if you would have done things differently?
Yeah. Well, anyone who knows a little bit about my story knows that I went through a pretty traumatic development project that I took on that I had no business taking on. That started in 2019. Really started in 2018, late 2018, 2019, and had a couple fires in the building in the course of construction of doing this redevelopment project, and just like couldn't have missed bigger in terms of doing this project and executing on this project. It was like an absolute nightmare. We could get into it later down the road in a future episode, but I would have handled that very differently and probably just wouldn't have bought the building to begin with. The amount of like brain damage and stress and heartache and stress that it caused, I was like, man, I don't think this is worth it. I could have spent that time, that mental bandwidth, those dollars doing something else that probably would have been a lot more fruitful, a lot less stressful. And I think I took on a bunch of other value add type projects simultaneously while that was going on and just spread myself way too thin. It ended up working out okay, and I was able to get out of those properties and make a little bit of money in the process, but I don't think it was worth it. Those lessons learned is something, I'll always have with me that I can take with me into all my future investing. And so kind of like you, we were joking, you're never going to get caught with that HELOC clause again in any type of HELOC. I mean, I'm never going to make the mistakes that I made with this property and with these projects again. So I think I definitely stuck the landing when it came to getting my financing in place. Missed the mark a little bit when it came to this particular property, but all my other properties, like I said, I was super diligent about getting as long-term debt as I could because I had a feeling this was coming. And so, no, I'm super, super pleased with how that turned out. But would love to hear from you, Tom, like turning back the clock, pulling back the veil, what would you do differently, or what are you super glad you did well?
Oh, thanks for asking, Michael. Thanks for asking. Well, no, this is more of like the retrospective on what I would have done differently. So I had a couple of like big expenses where I built like a ground up home office, which is like really awesome. I'm in it right now, love it. I ended up using a chunk of my HELOC to do it, and before that I had refinanced my house into like some good terms. Then I spent a bunch of the HELOC to build it, and the mistake was I should have taken that HELOC balance and just refinanced again and paid it off with that like cash out like refi to wipe out the HELOC. And it's kind of been sticking around me, like I'm like slowly chipping away, but it's like this little what's the word? Democles? Who's that? What's the sword or pushing the stone up the hill? Sisyphus. That's the right thing. So to repeat, I mean, super relevant for this episode, like at the point at which the rates were like pretty opportunistic, I should have, squished the HELOC with a refi. So like tying both of these concepts, together for personal experience, I did not. And I have like in both of these, like loan to value is like a really important because it kind of enables you to be able to do stuff if the value of your home is worth more than your mortgage. I have like a very low to value, meaning that on my personal home, it's like there's only like 50% or 45% of a loan, meaning that, oh my gosh, I had so much more runway to take money out on a cash out refi using awesome rates from back in the day and wiped out this. So I'm like kind of in this like funny financial position where I have like still a little bit of HELOC date that I'm just, slowly pushing through. But then, a really small home mortgage loan, which is great, but it's like I have all this interest eating me up, on the HELOC and, making progress on it. But there's like no chance I'd ever want to refi my home mortgage where I would much rather have done that when the terms were, more favorable. So, I think it's a good kind of like tying both of these concepts and that, they kind of work together, with the big kind of difference being
Absolutely
the HELOC being variable, the FELOC being kind of use as you need it. And the refi being, more permanent and opportunistic to leverage when the timing is right. So a little personal anecdote on these concepts as oh man, what I would have done hindsight a little differently.
Well, I'm so glad you're sharing that, Tom, because I think it is such a great point. And it's actually something that I'm in the midst of doing right now because I'm in the middle of a big home renovation. And we're going to be doing exactly that when we finish, is going to get a cash out refi or a rate and term refi rather, and then to pay off the entire balance of the HELOC for just that reason. Because my HELOC right now is at 9%. My home mortgage is at 6.5%. Rates are maybe going to be up a little bit by the time we get to the refinance down the road. But to be able to wrap the HELOC balance in and pay it off all in one fell swoop and amortize that payment as opposed to making interest only payments is going to be super beneficial. And so it's not going to add a ton to my monthly payment of my mortgage. Of course, I'm going to be paying it off longer than if I would just pay it off super aggressively, but I'm okay with that in terms of my monthly like out of pocket expense. And then I've got the HELOC able to deploy again into something else should I see a good opportunity present itself.
The last thing I'll say is like somewhat unrelated, but like relevant for like us three, having worked at like in startup land is like advice I would give to myself also in that time is like whenever there's opportunity for liquidity for like startup equity, like always trim a little bit. If there's chances to get some money off the table, do it. Like that's another piece where it's like, would have done things a little bit differently. So, unrelated to HELOC and cash out refi, but for any folks that are working at startups that do like equity stuff, like whenever there's opportunity to get some chips off the table, like do it. Cause you never know kind of like what is around the corner.
Yep. Playing with house money is the best way to go.
Yes.
Awesome, everyone. Well, thanks. Thanks for hanging out with us. Hopefully this was helpful, a little bit insightful about the differences between cash out refinances or refinances in general and HELOCs, how you can use them to your advantage, what things to be thinking about if you are thinking about making that decision between a HELOC or a cash out refi. We hope you enjoyed it and we'll see you on the next one. Happy investing.
Happy investing.